Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. 8 weeks ago, I laid out two possible scenarios going forward for this market, and I quote, "The primary focus is on what has developed from a bear channel into descending expanding wedge pattern, highlighted in bright green on my daily chart, and originating from October last year." That's currently 663 to well off the bottom of the daily chart. The upper trend line here has had the added benefit of the short medium moving average, currently at 735, entwined about it since late November last year. End of quote. As we entered February, the trend line and the short medium moving average parted ways, but both are still heading lower. This time the move was backed up by the declining medium moving average overhead. It's currently at 757. This moving average had capped prices in February. It was at this time, moving from February into March, that a partial repair took place of the broken descending expanding wedge pattern, with prices dipping below the upper trend line. But it had been a controversial period. You see, the market was also wrestling with two key supports, one of which is unique. They are the gap from July 2021 between 657.5 and 659.5, which we've still not filled, and a little higher, the 50% absolute Fibonacci line at 682. This is why prices exited, re-entered, and once again re-entered the descending expanding wedge pattern. I previously made a point of noting this 50% absolute Fibonacci line in my commentaries. Now, to be honest, I'm not happy about this wedge pattern, and I'm thinking about downgrading it after this commentary. You see, last week it was very much looked as if we might have a possible early November last year to date bearish halfway hesitation, which would have fitted in nicely with the idea of a drop down to target X at 609. However, that idea of a bearish halfway hesitation, whilst I've not completely ruled it out this week, is very much on life support. We may instead see a different pattern. Possible double bottom formed over March, the second leg seemingly strongly supported by the last 3 days of last week forming a 3-day bullish doji star pattern. But this continues to be a watch and see market because we're not really moving higher. As we can see yesterday, the high was capped by the short medium moving average. And I would have thought maybe we'd have another crack at it today, but we don't seem to be doing that. Too much indecision. Chicago corn. For many, many weeks here, the chart has been a headache with so many things going on to me. However, 5 weeks ago, all seemed to be settling into a pattern order. The July to October 2022, this is wrong. Chicago corn. For many, many weeks here, this chart had been a headache with so many things going on for me. However, 5 weeks ago, all seemed to be settling into a pattern order. The ascending wedge pattern was the key pattern here, originating in November last year through to the end of February this year. Personally found this to be a very elegant pattern. Thus, the end of February, the market punched down through the lower tine, which is highlighted in green, of the July to December 2022 bullish shift pitchfork, which made up that wedge pattern, the downside of it, the lower trend line. This segues nicely into something I wrote 6 weeks ago, and I quote, "I now come to the two key and recent elements of the market, the lower tine of the July to December 2022 bullish shift pitchfork, which I've highlighted in bright green, and the neckline, currently 696, of the November 2022 to January this year reverse head and shoulders pattern. Now, you can look at these two elements on their own, but I would urge you to look at them combined into a new pattern, an ascending wedge pattern. The elegance of this pattern is sublime, especially as it has been made from two separate patterns. Currently, the pressure is for a break lower as the long moving average is squishing the market lower, but I will not set out any targets for this pattern until one or other trend line is broken, but I can give you an idea of the size of the moves likely. Thus, for a confirmed break lower, it would have a primary move of about 13 cents lower and a harder to reach secondary move of about 42 cents lower, and that's the end of the quote. Thus, 5 weeks ago, we had that confirmed break lower I was looking for, and this gave a primary target below of 661 and a harder to reach secondary target of 632. The same week as the break lower, the market reached the primary target, and the week after, prices reached the secondary target. Now you may think, well, that was enough, but no. There have been further developments, 3 developments in fact. Firstly, and still undergoing finalization, is a possible dead cross of the medium moving average, currently 656, down through the long moving average, currently also 656. This has been going now for quite a while, and we still have not had a resolution. I'm getting bored with it. Please note this is also a lagging indicator. Secondly, we had over the turn of the month of February into March a possible bear flag with a potential target X in the 590 zone. Thirdly, and finally, we had seen the market drop down to the next key support and get stuck there for nearly 3 weeks before reacting higher last Friday, and the first part of also this week. What this reaction back up has led to is a retirement after this commentary of that target X at 590, the potential target for the bear flag. This is now not going to happen. It also has led to a reevaluation of the purple lower time, currently at 613 of September 2021 to July 2022 bullish shift pitchfork. You see, this pitchfork had never previously been tested on the downside on lower time, but the middle time above, currently at 752, had managed to cap the market back in late September and October of last year. Hence, as I said last week, it deserved some respect, and it had thus proved to be true, as it held up the market and stymied the opportunity to reach the bear flag target. It was again enough, as I said last week, that there was enough to make a possible reactionary weekly key reversal up for last week, which we did. Now, we have seen a follow-through higher this week to this weekly bullish pattern, but apart from Monday's brilliant action, it has admittedly been higher but also indecisive, which is a bit of a concern, as we're in a fairly free area, one would think. I realise that the December 2022 low at 635 may be there as overhead congestion, but given the early March move up to 642, you'd think we'd still have some slack to gather in topside. I would urge keeping a weather eye on this indecision, just in case it turns back lower, as realistically I would have thought it reasonable to see a rise up to greet the declining moving averages overhead, with seemingly so limited resistances overhead.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.